let's look at the economics and some of the problems with insurance. As discussed in class, insurance is a contract to manage risk. Now, we're not eliminating the actual physical risks, but we are changing or managing the financial risk. And because most consumers are shown to be risk averse, meaning that they are unwilling to accept risk without compensation, or another way to say that is that they're willing to pay for certainty, to the extent that insurance can give them more certainty, it is a net gain to society. If we look at the size of the insurance industry in this country, we see that there is a large and growing fraction of the U.S. national income being spent on insurance. If we look at health insurance, private health insurance is over $1 trillion per year. Publicly provided health insurance is another $1 trillion. People spend around $700 billion on life insurance, around $300 billion on auto insurance, and so forth. So we're at a really important part of the economy, and for good reason, right? It does manage risks that can be financially unbearable. There are many other types of insurance that people have the option to buy: homeowners insurance, renters insurance, and then insurance-like instruments, so extended warranties or service contracts. So if you buy an Xbox, Best Buy will sell you accident protection. So if you drop it and break it, for $49.99, you can have coverage for 2 years. So there are many things that we can insure for. But what I'd like to look at is something where we might be interested in insurance and yet it is unavailable. So let me consider the insurance for speeding tickets. Speeding tickets can be very expensive. In Michigan, speeding in a construction zone can be $400 plus fees, court fees and surcharges. And the question is, would insurance for speeding tickets be a good business? And if not, why not? So certainly there's an incentive here for people to buy this kind of insurance, but there are some problems with it. Right. One is, who would be most likely to buy this insurance? Right? People who drive safely or people who speed. And of course, this insurance would only benefit people who speed, and that's going to push up the cost of providing that insurance. Right? If everyone who buys the insurance are speeder, the company's going to have to pay out many more speeding tickets. And this is known as the adverse selection problem, and it exists in many types of insurance markets. The second incentive problem is a behavior problem, and that is, if you have speeding insurance, you are much less likely to take precautions. You are less likely to slow down if you think that there is a police car. You're less likely to use a radar detector. You're less likely to drive the speed limit, because even if you're caught, someone else is going to pay if you were able to buy speeder insurance. Right? And this is a moral hazard problem. Changing behavior because someone else is paying the costs. Right? So the moral hazard comes because there is less incentive to invest in precautions, and this exists in many kinds of insurance. Let me turn to perhaps something that is more important, certainly more real than our speeders insurance, which is not available, and that is health insurance. And let me look at the Affordable Care Act of 2010, known as Obamacare. Now, one of the things that was part of that act is a requirement that everyone have insurance, and this is known as the individual mandate. Right, and so people could either be insured through their employer, they could have public insurance, they could be insured by their parents or other family members, or they would have to buy it themselves. And this was a very controversial part of the Affordable Care Act, and it met many different legal challenges, but was eventually upheld by the Supreme Court. Now, the reason the individual mandate was in the law was because the insurance companies lobbied very hard to make sure that it was included. What were they concerned about? Well, they were concerned about adverse selection. In general, health insurance is a better deal for riskier people. And that means that young, healthy people, if they don't participate, are going to raise the overall costs. So again, this is the same problem of adverse selection. And if or if you don't have enough contributors, then the insurance system isn't going to work. In terms of moral hazard, it's a little more difficult to say. There may be some people who take some more risks, maybe going skiing without a helmet or being a little less careful, although most insurance have co-pays where people have to pay several $100s, and that may reduce some of the moral hazard problem. Now, during the Trump administration, Republicans who had been clamoring to get rid of Obamacare had been unable to come up with a replacement or to repeal it, but as part of the tax reform passed in December of 2017, they did eliminate the individual mandate starting in 2019. And so the projected impact by the CBO was that we were going to see an increase in the people who were uninsured because they were not required to, and that does seem to have happened. Now, the employer mandate was not changed. Most workers remain covered through their employers, but the predicted impact on insurers was that they were going to have less revenue and higher costs. And that would either cause them to increase their premiums, the prices paid by consumers for insurance, or that some of those insurers would drop out of the marketplace altogether. And we will see what the new administration brings to the healthcare insurance, in the coming months and years. Let me end with a very specific example from 2010. And this happened in South Fulton, Tennessee, where residents outside the town limits had the option to pay $75 to have fire protection from the town firefighters. And there was a family, the Cranick family, who lived just outside of the town limits, and they didn't pay. Now, they had a shed caught fire, and the firemen wouldn't put out the fire. The family offered to pay the $75 fee at that point. They offered to pay even more, just an open-ended, put my house fire out. But the firemen wouldn't accept it at that point. When the fire did spread from the shed to the house, and the firemen were there, and they watched it burn down. Now, the fire did spread to the neighbor's field, and the firemen did put that out, and that was because the neighbor had paid for that service. So it's important to know what model you live in. My analysis is that the Cranick family thought they were free riding on a public good, that they didn't pay, and that the firefighting service would be there because their neighbors. But in reality, what happened is they declined to take insurance, to buy insurance for a risky event, and when their house caught fire, they didn't have protection. Now, they did have an insurance policy for their home, but it wasn't with the firefighters, and so they, I think, were able to collect from their own insurance, but the damage had been done. Anyway, this has been Chuck Stull looking at insurance.